Hi, my name is Matthew Stearns. I'm the owner of Brookhouse Advisors here in Meadville. And today I'm going to show you a sneak peek of a few slides that I pulled out of my client presentation that I sent to all of my portfolio management clients that I think will be helpful for the public and to just give you a little bit of information to prepare for the year ahead. This isn't a prognostication on what's going to happen this year, but this is just some useful information to have in your back pocket as things might evolve. So I'm not going to kind of give you my opinion on where we're going or anything like that, but these are really fantastic slides, I think, for people to understand how you can preserve your capital if we have a downturn in the stock market. It's considered a bear market, which would be down more than 20%. And what are some different places you can have your money rather than just in, the big growth companies or the S&P 500? So I think this is just really great information. It's a fantastic chart here put together by Hussman Strategies and Hussman Research. They do great work. I followed John Hussman for many years. But what they did in this chart was they compiled all of the bear markets that we've had going back to 2020. So they basically took you from the peak to the bottom, then added that to the next bear market and kept going down and down and down and down. So they basically added up all of the drawdowns on top of each other of basically the last six drawdowns. So you can see there in the blue line, you have the 2000 bear market, the dot-com bubble where all the tech stocks burst. 2007, you have the big bear market of the financial crisis, and then we have a little bit of smaller ones here kind of throughout the past decade. But on the right, you can see the different asset classes and how they performed cumulatively during this bear market. Okay, so those bottom sloping lines, those are all stock funds. Okay, the gray line that is down in the bottom right hand corner, that represents the S&P 500. Okay, and that cumulative return is minus 37%. You have emerging markets, then the EAFE, that's Europe, and some other countries in there, all down around 40%. But I want to draw your attention to some asset classes that actually, built wealth during these bear markets. We have long-term treasuries at the top, so that would be 10 to 30-year treasury bonds. You can buy these, via an ETF or a mutual fund. You don't have to buy like individual bonds. Individual treasuries next, and gold. So you have basically what we call the low risk assets, the assets that people pour into when things go wrong. And I don't necessarily mean your average day people, but institutions, hedge funds, banks. They say, okay, we have a problem in the economy, we have a problem in the market. I need to run to U.S. Treasuries because U.S. Treasuries are basically dollar collateral. If you're an international fund, you want Treasuries, you want to shore up your dollar position. And they do the best in crisis. So these are things that you could add to your portfolio that might offset things. Tips I wouldn't recommend for the regular investor. Investment grade bonds, almost flat, but still a very good defensive force in your portfolio, and then some other things that might not be as attractive. So this is kind of a good visual of what types of bonds you could own that are better than others. There are some risks associated with long-term treasuries. They can actually fluctuate in price quite a bit. But just a great visualization here. I'm going to go to another slide that's very similar. We have different styles. So within the stock market, now we're going to compare different styles of stocks to the S&P 500 general stock fund. Okay, so if we put the stock fund as the median return, what returned higher and lower? So the worst performing types of stocks specifically are your large growth stocks. So these are the stocks that have done really, really well. These are your Apples and Nvidias and Microsofts and Teslas. Okay, and then we have other large cap value, momentum. These are all really the big trendy stocks that have been doing well. Typically in a bear market, they're the ones that experience the most pain. Okay. And then on the opposite end of the spectrum, we have lower volatility, high dividend stocks that are really built to be more consistent. They're not your big high-flying technology names. They're things that your everyday products, your Procters and Gambles, your Coca-Colas, your Colgates. So this is another way you can say, okay, I'm a stock investor. I don't want to buy bonds. That's kind of gibberish to me. What types of stocks can I own that are going to protect me better? And here's a great picture. And then we can break it down one more step where we can look at what types of stocks by sector do better. So at the bottom there in the blue line, we have information technology. So same thing, all these big tech stocks, communications, same thing. Communications would be like your Facebooks, and banks, typically doing the worst in a crisis. And then what's doing the best? Consumer staples, things you buy at Walmart, like I just mentioned, Colgate, Procter & Gamble, Clorox, Coca-Cola. Then you have healthcare is usually a high performer. People tend to transition their money from what they perceive as high growth technology into high growth healthcare. That's a trade that typically transpires. Utility, energy companies as well. These are usually things that have lower stock price valuations, and can kind of offset you during a bear market. So that's just a little bit of a clip today that I hope you find helpful. Like I said, I'm not making a call here, but it's just good information to have in the back of your mind. When we inevitably do have a bear market, which will happen sometime in the future, it's part of being an investor. So thanks for your time. Have a great weekend. God bless.